several emails from people saying that they couldn't make it today because of illness or their own or their parents or whatever the situation is. So unfortunately some people couldn't make it, but V is standing guard on the video. So let's just talk about where we are and what we're doing, because today we're going to get as practical as we can be, and we're going to try to put it all together for next week. So in terms of material, the casebook, again, you can see, guys, why I'm interested in trying to put together a new casebook, because the casebook in many ways is a challenge, okay? There's a lot of esoteric language, and it's not easy. For the exam next week, you'll see the exam, the languages, you're going to see very straightforward. We're going to try to keep it as simple as possible. Don't get mad at me where you say, this is too simple, this is too easy, all right? So don't be frustrated. Well, you know, keep in mind, I will try to keep it as straightforward as possible. And again, I just want to emphasize that this is our 6th class and our 7th class again. So we're all together on this. Next week is the midterm exam, all right? So, and I will be around the entire week. I will not be going anywhere, so if anyone has any questions or issues or you get stuck, I will try to keep the casebook close near and dear to me wherever I go over the course of the weekend. All right, so let's just bring ourselves up to date, because I want to make sure we get up to page 205, ideally for the exam. So very quickly, chapter 1, everyone go ahead.
Just a question on the exam. Will we have to reference this document?
What do you mean by reference it?
Can we use it?
You're gonna, the book is open exam, open note. Let me just, since you raised it, you can bring whatever you want to the exam with the caveat, nothing electronic, okay? So no Apple Watches, no cell phones. Only thing you should have is a simple calculator, okay? And that's it. But anything else you want to bring, please feel free to. All right? And if you can, I'll say it again, use the restroom beforehand. That would be great. I think we can all. The exam itself will probably be an hour and a half hour, 45 minutes, 2 hours, something along that in that time frame. All right. So anyway, chapter 1, and again, some of this chapter 1 is introducing, and I've tried to supplement where necessary, just getting down your vocabulary for this course. What do certain terms of art mean, from a testamentary trust to an inter vivos trust to the GST trust, all those terms of art. During the exam, you get stuck with a phrase, I'll be in the back of the room. I'm not testing you necessarily on your mastery of vocabulary. I'm testing you on tax issues. But if you get stuck on a word and you're not quite sure what it means, feel free. I'll be sitting in the back. Ask me what it means, and that's fine. Hopefully you will know what it means, but again, I'm just testing you on the tax consequences, not your, obviously the vocabulary helps, particularly in practice. All right? Chapter 2. And by the way, I got a call. Do you guys, anyone read the magazine 360 online? There's an online journal called 360. Anyway, I got a call today from one of the reporters following up on the, most of you know about Donald Trump and some of the gifts and trusts that his father set up, right? Fred Trump. And those trusts were not set up to save income taxes. Well, they were really used as a vehicle to transfer wealth to Donald, and I think Donald has 3 siblings. So they were used as mechanisms to minimize Dad's gift tax burden and camouflage it through the use of different vehicles. There was a grantor retained annuity trust. He set up a whole bunch of different trust vehicles. Again, the purpose was not to
Does it
save.
look like this?
Income tax, yes, that's it. Purpose was not to save income tax, save transfer tax, because remember, after 1986, Code Section 1E, the rates are very compressed, right? So that people generally did not set up or do not set up trusts to save income tax in post-1986 with the caveat, some people set it up to try to save state income tax. But largely trusts have been a vehicle to try to save transfer taxes, and people set up trusts because they want to protect the assets from someone's spouse, keep it in the lineal lines, immaturity, all those kind of things, why people set up trusts. People don't set up estates because they want to. People set up estates because they die, right? So, one is voluntary, one is involuntary, right? Chapter 2 talks about general principles of taxation, and we saw with respect to general principles of taxation that in the face of a 1041, and we'll try to go through this more today, it's very similar, right? A Form 1041, very similar in nature to a Form 1040. Many of the principles that you guys hopefully picked up in your income tax course, you see spelled out on the face of the 1041, particularly, again, the front page. And if there's a caveat, and we're going to see more of this, is with respect to allocation of expenses to tax-exempt income. And we had the Manufacturers Hanover case, but we see that when you take certain of these cases and principles, they come down to simple numerators and denominators. And what the issue is, what's in the denominator, right? And we saw Manufacturers Hanover said you don't include capital gains. But sometimes you will include capital gains in the denominator if it's considered part of D&I. Right? And again, we'll take a glimpse at some of that today. And we talked in general in Chapter 2 about Code Section 212 expenses, looked at Manufacturers Hanover. If you get a chance, I've said it, this is class 6, I think I've said it 5 out of the 6 classes, so a little repetition on my part. But if you look at beginning on page 57, 58, 59, sorry for my repetition, but I promised you that if you hung with me through the entirety of the next few weeks, and I was back in week 2, that these pages should begin to make more sense. That you should have a better idea of what is fiduciary accounting income, allocation of expenses, tentative taxable income. On the bottom of page 58, they have D&I and ceiling amount of distributions. Keep in mind, one of you asked me, well, which is the column you should be looking at? Well, bear in mind the IRS prevailed. So, notwithstanding what the taxpayer, the column under taxpayer, that is not the current state of the law, right? So, the authors just had that column there to illustrate or demonstrate the flaw, the perceived flaw in the taxpayer's analysis. All right, so again, repetition on my part, but please go through that. Chapter 2 continues and elaborates a little bit further how manufacturers over how that case has been explored. And then we looked at some other issues under 642C, the charitable deduction, depreciation and depletion. We took a look at, and essentially that goes wherever the income goes. We ended chapter 2 with a discussion of passive activity loss limitation rules and how they apply to trusts and estates. We then began chapter 3, and I said to you before that chapter 3 is a big distinction between trusts and estates comes down to this distribution deduction. Okay, normally, when a corporation makes distributions, right, a corporation does not get a deduction, right? A corporation does not get a deduction. And if you're dealing with partnerships and S corporations, which are so-called conduit entities, It's all immediately flows through to the beneficiary. And trusted estates occupy this unique vantage point where, depending on if distributions are made, the question is, who gets taxed, right? Not how much gets taxed, but again, who gets taxed? It comes down to, will the entity be taxed, or will the beneficiary be taxed? And what helps calibrate who will be the taxpayer here is this concept of D&I, right? And just to get very, very practical, it all comes down to what? Schedule B of your Form 1041, right? Which we'll look at again in a few minutes, but if you recall, Schedule B of your 1041 helps define what is D&I. And by knowing what is D&I, we can then calibrate how the beneficiaries might be taxed. And keep in mind, D&I is not only D&I, right? But it's modified D&I ultimately that ends up on the front page of the 1041, right? Modified. Or another word for modified D&I is IDD, as in income distribution deduction, which is how it's actually spelled out on the Schedule B of the Form 1041. My point is, D&I is not necessarily what ends up on the front page of the 1041. It's this modified D&I, or income distribution deduction. And that's what Chapter 3 is about, right? And there's other facets of Chapter 3, but that is, in essence, one of its fundamentals. So the first part just talks, and we're going to revisit this, is something income or a bequest, because if it's purely a bequest, most of you recall, right, Valerie, that bequest is not subject to tax. Valerie, under what code section? Valerie? The receipt of a gift or bequest is not subject to tax. Under from your income tax course, Valerie. 102. Right? Yeah. Gotta know that. But the income on a gift or bequest is not safeguarded from taxation. The income from a gift or bequest.
102, I said the gifts and inheritance.
Right. The gift or inheritance is not
okay. You used in bequest, I'm like confused.
I see. Okay, but gift, inheritance, bequest.
Okay.
No tax. Okay? All right, and the authors then begin the discussion on page 123 of D&I. And D&I is encapsulated right under code section 643. Talks about how to compute D&I. And here, or if I, hopefully no one will get mad at me, if I asked you during the exam in a simple problem to compute the D&I of a trust or an estate. And the authors go through several permutations, then talks about distributions to beneficiaries. Keep in mind, what is a SMO? What is a simple trust? And Dane, see if you agree with her definition. Sure, Dane, you want to start, and then Simone, you can take it off.
So a simple trust is required to distribute all its income.
Okay, have anything to add to that, Simone?
They can't give charitable deductions.
Right?
So, just another point, a simple trust can turn into a complex trust.
Absolutely. Status can change from year to year. Everyone agree? Simple trust can be a complex trust. A complex trust can be a simple trust. Okay? Keep going. Anything else? No charitable trusts. Go ahead, Alicia.
Can't distribute corpus.
Can't distribute any corpus, right? No corpus distributions. What code sections govern a simple trust? 651 and 652, right? And John, what's the definition of a complex trust? John? Yeah.
Basically do one of the things that were kind of outlined in the simple trust. They
Right.
do the things.
Essentially, if it's not by default, if you're not a simple trust, you are a complex trust, right? Don't look for it in the actual code. The regulations are what define it, right? The regulations define, they do that definition. And then, Young Hong, what code sections govern complex trusts? Just say it loudly. 661 and 662, right? Everybody right? 661 and 662. That sort of brings us up to page 178. And we're on page 178. Any questions? Any questions logistically about the exam or anything else? Anything before we go on? Quick station break and then we'll continue. Pat, I know it's Wednesday. It's always, well, should I ask what you have coming up this weekend or what you did last weekend? But anything exciting? I think Dee saw a comedy show. Who did you see this past week?
It wasn't a comedy show.
Oh, yeah, that's right, burlesque.
Yeah, but it was better than comedy shows.
Where was it from?
It was really funny. They had this burlesque festival going on at in Times Square. I mean, at the Sony Hall.
Were you there Saturday?
I was there Saturday. Yes.
I could have seen you on the streets of New York. I was there at the comedy show right in Times Square. It was the zoo, I said.
Was that the LOL comedy show?
Comedy Central. Anyone else do anything? I did see on Sunday Pretty Woman, and despite the reviews, I thought it was pretty good, pretty well done.
Will it win any Tonys?
Broadway show.
Any Tonys in the future? You think?
I don't know. It's people are going to consider it too shallow, probably, to win a Tony, but it's entertaining.
It's nice music.
Yeah, I mean the lyrics were creative. We all know the storyline. The only difference is, and I don't think I'm going to give away anything, we've all seen the movie. Everyone has seen the movie. The 2018 version, if you recall, Jason Alexander takes Julia Roberts towards the end and like accosts her, right? And Richard Gere has to come in and sort of rescue Julia Roberts. In the play, she beats the heck out of him, and Richard Gere, the equivalent of Richard Gere, what's his name, Edward, comes in and sort of says, "Great job beating him up."
Yeah. Hashtag Me Too.
What? Me Too.
A result of the Me Too movement.
Exactly. So a little bit different take on that. Anything else? Anyone do anything else? Aaron.
I was at down in Asbury Park. They had a 2-day music festival, See Here Now. It was like right on the water, I mean right on the beach. Well, there was 2 stages on the beach and then one up on the park. It was, yeah, all day Saturday, like 1 to 10 Saturday, Sunday.
What are my other students? What was the lead group on that?
Well, there's there's bigger ones like Blondie was there. Like she actually was really good. I couldn't, usually as you get older, you can still play the music, but your voice goes. I mean, she was really hitting the notes. But Jack Johnson was like the headliner on Sunday night. He closed out, which a lot of people came just to see him because he lives in Hawaii and he does shows in just basically Hawaii and California, and he never comes East Coast. So there's several other bands that were also from Seattle and stuff like that too. So
Was it weather-wise?
oh, it was like absolutely perfect.
It
It was
couldn't be
good,
better.
yeah, because it was so crappy during the week, and I was like, please don't be like this.
There you go, Jersey Shore at its best. You guys ready to move on? All right, good. And this weekend, guys, I want to hear how, I won't call it boring, but how exciting it was studying subchapter J, okay? So Karen, no shows this weekend.
Yeah,
No burlesque, all right? All right, complex trust. All right, let me just make some observations here. All trusts, which aren't simple trusts by definition, are complex. We got that out of the way. This includes trusts which are authorized to accumulate income, whether or not they actually do accumulate income. Trusts which distribute corpus during the year in question. And any trust entitled to a charitable deduction pursuant to Code Section 642C. The regulations add all estates are by definition complex trusts, or treated as complex trusts, okay? All estates are treated as complex trusts. What is, now that we said that, right, Shane, we've said simple trust, complex trust, I'm a client, right? Tell me, why do I care? What's the difference from 30,000 feet up from a tax principle between a simple trust and a complex trust?
Exemption is different, but it's like very small.
No, it's not. It's not different. Remember, a complex trust that distributes all of its income still gets a $300 exemption, okay? Hear me on that. A simple trust, it's not that a simple trust gets a $100 exemption and a complex gets $300. Everyone hear me? Any trust that distributes all of its income gets $300. So by definition, a simple trust must. But a complex trust can distribute all of its income too. So any difference in tax, or are we just going to give it, why give it different names? What is the fundamental difference between a simple trust and a complex trust?
Tier system.
Say again, Ping?
They use a tier system.
Tier system. A tier system. And, Ping? How many tiers are there?
Oh, they have two tiers. The first tier, which is similar to the simple trust. The second one, which is other than the simple trust, occurring other than the current income distribution.
Okay. So there are 2 tiers. That's key. 2 tiers. And a simple trust, let me rephrase it. Tier 1 relates to a simple trust. That relates to the tier in which all income must be distributed. Right? So, tier 1 beneficiaries, those are beneficiaries to whom income is required, I have in caps, all, the word required is in all caps, to be distributed. And tier 2 is all other beneficiaries to whom the entity properly pays or distributes. Okay? Essentially discretionary distributions. Now, you may want to open your code to Code Section 661. Notice, under Code Section 661A, in any taxable year, there should be allowed as a deduction in computing the taxable income of an estate or trust, the sum of, so you get a deduction of, A1 represents tier 1, and A2 represents tier 2. Isn't that nice? Tier 1, any amount of income for the taxable year required, I have the word required underlined, required to be distributed currently, and tier 2, any other amounts properly paid or credited or required to be distributed for such tax year. And look, are we going to be surprised by the next phrase? But the deduction shall not exceed D&I. There's a shocker. And then, glad you're all sitting down. Look at 661C. No deduction shall be allowed under this subsection for any portion of amount allowed as a deduction under that subsection, which is treated under subsection B as consisting of any item of D&I which is not included in the gross income of the trust or estate. You have a word or two that might replace all that? What is that referring to, guys, in our language? You guys know it. Isn't that modified D&I? Isn't that the same thing you see with simple? If you look at 651, doesn't that have virtually the identical language? And the character of the amounts distributed is going to be a pro rata amount, right? Now, with respect to inclusion amounts, with inclusion amounts, look at code section 662. You'll see 662 has A1, which is essentially the tier 1. It's the amount required to be distributed currently. And then 662 A2, which is the second tier, right? And here, the code certainly looks for symmetry. Everyone agree? Code certainly looks for symmetry. And the character of that income essentially is going to be the same character as the D&I. So let me just make one, I have lots of points to make, but whether you have a simple or complex trust, the D&I computation under code section 643 is the same, okay? So good news, you don't have to employ a different computational mechanism to compute D&I. D&I is universal, it's found in code section 643, and the fact you're dealing with a simple trust or complex trust will not change how you compute D&I, okay? How about if D&I, let's take one scenario. We have tier 1, the distributions are greater than D&I. Tier 1 distributions are greater than D&I. And what I mean by that is, suppose D&I is $10,000. Just see if I have it. D&I is $10,000. We have tier 1, we have tier 2, and there's 3 beneficiaries, A, B, and C. 4,000, 4,000, 4,000, distribute 10,000, tier 2. What's the D&I allocated to A, B, and C in this? Carlo, what do you think? And then B, C if you agree. What's the D&I allocated to the 3 different beneficiaries? How much D&I will be allocated to each? A, B, and C. A's going to get 14,000, B's going to get 4,000, C's going to get 4,000. How much D&I is allocated to each?
Three.
Javier, you agree with me? How much? What's your final answer be?
3,333 to each.
Javier, agree?
Yeah.
Yeah. In other words, tier 1 takes priority. Everyone agree? And it's based on 4,000 over 12,000 times the D&I, right? Because each one's going to get a pro rata amount of the available D&I. Agreed? Tier 1 takes priority. Okay, you okay with that? Okay? There's 12,000 at tier 1. There's $10,000 at D&I. Each one will be getting a third.
I'm sorry, the 4,000 each, is it required each for, or you just paid each for?
I'm sorry?
Was it required to distribute
Yes.
4?
Otherwise, it would be a tier 1 distribution.
Oh, I saw, maybe if like A was required to get 4, but B and C were only required.
By
to get
definition,
4.
it must be a required distribution.
Okay.
Okay? Right. Tier 2, second one, let's go through. Suppose tier 1 is less than D&I, or D&I exceeds tier 1, and tier 1 plus tier 2 is greater. Tier 1 plus tier 2 is greater than D&I. By the way, this is all found in 662A1. 662A1, right? Tier 1 distribution. And let's take tier 1 and tier 2. Let's take D&I again, $10,000. And have A, B, and C. Oh, I made a mistake. We got that? We have A and B who are getting tier 1 of $4,000 apiece. A is getting a discretionary distribution in addition of 2,000, and C is getting a discretionary distribution of 4. Figure out how much D&I is allocated to each. Let's see. Think about it for a sec, come up with some numbers. Okay, what do you have? And Harsh, see if you agree. Yeah, how is the D&I here going to be allocated?
For the A, 4,000 plus 20, 30.
Again?
4,000 plus 20, 30.
Let's just go with tier 1 first.
4,000 and 4,000.
Okay, everyone agree that tier 1 takes priority. And tier 1, there's going to be, the D&I is going to be allocated to A and B $4,000 apiece, right? Everyone agree? Tier 1 takes priority. How much D&I is left after you allocate to tier 1? We only have $2,000, right? And then how are we going to allocate that $2,000, DK? 1/3 of the 2,000 to A, 2/3, right, to C, right? Everyone agree? You agree that we have $2,000 left, right? And now it's based on the size of the distribution, right? And we have $6,000 being distributed. 1/3, 2/6 times 2, 4/6 times 2 will be the allocable portion of the D&I. Yes.
But I think what he's saying is that for tier 1, the total distribution of tier 9 has to be $10,000, which is how you got the 2,000.
Well, D&I is a number that we already know. It has nothing to do with the distribution. Right? We can view D&I based on the income of the trust, right? Now we're just allocating it to the beneficiaries.
That's what I meant, I'm sorry. Allocating the D&I, not making the distribution. So you have 4, 4, and 2, right? For a total of 10,000 for tier 1.
No, the 2 is not there. We only have $8,000 being distributed in tier 1
Okay, fine. So there's $2,000 left over to be allocated, correct?
to tier 2.
Okay. So with that said, you're taking the ratio of tier 2.
Right.
I just wanted to,
That's,
okay.
okay.
Thank you.
And that's what we did here. We only had money D&I to cover tier 1. And that's why we took a pro rata share of tier 1, right? Everyone with me? Now, I mean, there's all sorts of different permutations. I mean, you could have a scenario where D&I, in this case, you have tier 1 plus tier 2 is less than D&I. Tier 1 plus tier 2 is less than D&I, and tier 1, tier 2, you have A, B, and C. This time, let's make it tier 1, 1,000, 2,000, tier 2, 2,000, and 2,000. And what do you think is going to happen in this scenario? Jen, what do you think is going to happen? Catching up?
Yeah.
Ming?
Is D&I still 10?
D&I is still 10 in this scenario. D&I would still be 10 here. So Ming, how would you treat this?
Tier 1 go first.
Tier 1 what?
Go first.
Goes first, right? So you'd have 1,000 taxable to A, or 1,000 D&A allocable to A, and B would be covered by the D&I. And what about tier 2?
The rest go to the tier 2, and then because they are the same.
tier 2, there's still sufficient D&I, right? To cover all of tier 2. So essentially the entirety of this, right? Tier 1 and tier 2 would all be subject to income tax, right? Everyone agree? Because there's plenty of D&I, right? So you have a combination of required and discretionary distributions, but it would all be subject to tax.
What about the
What about
trust?
the, yeah, what about the remaining $3 grand?
Does the trust not get the full deduction then?
Yeah, the trust just doesn't get the full deduction. Okay. Implicit in that is that the trust probably, without knowing more, will be taxed at least on $3,000, but there could be capital gains, right? Capital gains don't go into the D&I, right? So there could be a very significant number where it would be, you know, don't just think whatever D&I is not distributed, that becomes the taxable income, right? Everyone agree? That may not be the case, right? So just be forewarned about that. Yes, going on.
I understand for tier 1 we don't have, like, we don't choose A gets 1, B gets
So
2.
3 grand goes
And the remaining 7.
We don't need that. We have enough covered. In other words, the remaining 7, right, will make tier 2 fully subject, will be treated as D&I. This 2 will be D&I, this 2 will be D&I as well.
And
We have 3 remaining, which remains in the, it just doesn't get deducted. Remember, D&I really serves as a ceiling on what's deductible and as a cap of what's includable. But that's it. Notice Schedule B on the tax return. It's just serving as a metric. B, you were going to say something?
Yeah, so the $3 grand that stays with the trust, under what circumstances is it not taxable?
I didn't say it wasn't non-taxable.
Okay,
It's not taxable to the beneficiaries,
right.
and it's not deductible by the trust or estate. So I'm going to assume for the moment that it will be taxable to the trust or estate.
You mentioned
But-
something about capital gains, so,
Well, I'm just saying capital gains generally aren't even part of D&I.
right.
So the trust could have another $100,000 of taxable income, right? I just don't want anyone under an illusion to think, oh, $3,000 wasn't distributed. I now know what the taxable income, of the trust or estate is. Okay? So your takeaway in a very simple world is that tier 1 gets priority. Everyone. So if you're a tier 1 distributee, you're more likely to be taxed than a tier 2 distributee. Everyone agree? That if income is required to be distributed to you, it's much more likely. And doesn't that make sense? In the terms of a trust, picture if you will, I set up a trust and it says EK gets all the income, and I'm going to make Jen the trustee, and Jen's the trustee. I write the trust, she's the trustee, and I instruct Jen, give EK all the income. And if you want, give Harsh some distribution. If he needs some extra money, I just want to protect EK. She's my first priority. Give her the income. Harsh needs something. I'm going to pretend for the moment. That's my wife, EK. Harsh is my son. I'm looking, you know, my wife is elderly. My son can make money. So leave it at that. Doesn't it make sense that the person required to get the income should take off the D&I first, right? Everyone, when you put it that way, EK harbors an expectation she's getting the income. She expects to be taxed, right? Most people would expect to be taxed at that. Harsh, on the other hand, is getting discretionary distributions, right? So he's really getting second fiddle. Now there could be a trust where I set it up, Jen's my trustee again, EK's my wife, Harsh is our son, where I say, you know what, Jen, you give it however you feel. my wife is a hedge fund manager. She's independently wealthy. She doesn't really need it. It's a second marriage. And my son is really a big priority in my life. You know what? You sprinkle the money as you see fit. In that case, right, the D9 is all tier 2, right? Everyone agree? Has a lot different aroma. And by the way, I did see the movie, big cultural weekend, Free Solo, okay? Do you know what movie that is? New documentary. There's a guy, there's several people who do this. They really need their sanity check, but they go climbing without ropes. Are you familiar with these people who and they climb, I'm talking about the face of cliffs without ropes, and they hold on to like little stuff in the rocks on these bare-faced cliffs. Anyway, this movie's a documentary. Nicholas Bassarelli, who teaches at Rutgers, his daughter has directed several movies, several documentaries, and this is like her 4th movie. And it's playing across the country. If you listen to NPR, you'll hear it advertised, but it's a fascinating movie. Not just because of the insanity of climbing, just the psychology of why people do these things. So if you're, it's hard to watch because you're sitting there, and you just, and they talk about other free, what they call free, I forget the verbiage, but virtually everyone else who does this dies. Okay, so he's still alive, the guy who's in the movie.
Right? The Canadian guy.
I think he's U.S. This
Oh,
guy.
okay.
Andrew, and I forget his last name, but if you want to
Arnold or Hamill.
I don't know his name. He's got hands like gloves, right? Because when you do that, you can only imagine that your life depends on that Spider-Man that you want to stick to the surface. All right.
Superhuman, like.
Superhuman, but I don't know if you're human to do that. It is insane. That's all whatever. All right, so everyone got the flavor? Tier 1, Tier 2? You can talk about it. If I ask an exam question or two about Tier 1 and Tier 2 distributions, everyone can handle it. No one would get mad at me. And we're going to look at several problems, okay? So this is not our only taste of it. I want to pause for a moment because I want to go through problem 2. We did not go through, I think I called it your attention. We didn't do problem 2, right? In the handout, right? We just talked about it, John? No, I do not. I do not bring any extras.
I didn't get it.
All right, but if you don't get it, guys, you got to ask a classmate. I can't bring everything with me. All right? So if you don't have it, maybe you can look over a neighbor's shoulders, okay? Because I want to spend a few minutes on this. All right? So if you don't have it, I really recommend that you look over someone's shoulders for now. All right? So example 2. Jen, you may want to look over it
Yeah,
for
I'll
harsh or, I mean, there may be two. Okay, so in this example, all right, we have a simple trust with taxable interest of $15,000, tax exempt of 10, dividends of 25, rental income of 25, total income 105. And we have expenses, rental expenses, fiduciary fees, professional expenses. Okay, professional fees, I should say. And I thought this is a really good problem to just see how things are allocated and treated, so you get more comfort to see how these things come out on a tax return. So akin to chapter 2, it's very simple. Interest income is going to be right on the face of the 1041. And notice, simple trust is checked off. Everyone see that? Simple trust is checked off. Ordinary dividends, $25,000. Nothing special about that. So the taxable income, notice the tax exempt income doesn't even show up, right? Everyone agree? So the total taxable income is $75,000. Now, why is the fiduciary fees and the professional fees, right? Why aren't they 10,000 and 2,000? In a nutshell, why are they not 10,000? Shane?
Some portion will be disallowed. The portion that's related to tax exempt interest is disallowed.
Okay, the portion, right, relating that indirect expenditure, right, that indirect expenditure allocable to tax exempt income, right, complements in the manufacturer's Hanover case, is not deductible. So, it's an easy ratio, right? You take tax exempt income over all income, and do we have to worry about manufacturer's Hanover here, the principle that it stands for? No, because there's no capital gains. Everyone agree? So the amount disallowed here is very simple. It's just 10 over 105, right? And by the way, if you turn a few more pages, the computer does this for you, okay? The computer actually does this for you on one of the worksheets. It computes the amount disallowed. On statement 3 and statement 4, it talks about the ratio, and it comes out with the ratio that we just described. So if you go a few more pages, it gives you that ratio in statement 3 and statement 4 of what's deductible. Everyone see that? Your computer will do it for you. So you gotta just flip pages right here with it, Valerie. You gotta flip about 4 or 5 pages further, where it says column 2 simple trust. There's a very interesting income statement 1 at the top. You see that? Hey, everyone see that? My point is, computer programs fortunately do this for you. But if some people are going to wonder, your clients are going to wonder, hey, why aren't I getting the full deduction? You can't just say, well, that's what my computer program says, right, guys? Got to be able to explain it to a client, or else, you know, your days are numbered as a practitioner. Okay? So that gets us back to the first page, right? Because now I have, you know, I'm back to the front page of a Form 1041. And we have our amount deductible. Line 17, that's the total adjusted taxable income. Notice it did not take the exemption into account yet. So that we go to Schedule B on the next page. That's the starting point. Everyone see that? Schedule B starts with tentative taxable income. And recall that Code Section 643 asks you to add back in the exemption, right? But you don't have to add it back in because it was never taken out. Recall, D&I takes tentative taxable income and then you add in tax exempt income, right? Everyone see that? That's line 2 of Schedule B. What's our D&I? 73,000. Everyone see that? Guess what? What ends up on the front page of the 1041? It's not D&I, right? It's modified D&I, or if you look at line 15, it's IDD, as in the income distribution deduction. Everyone see that? And that number ends up on the front page of the 1041. Now we get, right? All the income is paid out, and therefore, right, Shay, we get a $300 exemption, personal exemption. Let me pause here. Everyone see, notwithstanding the Herculean task you guys have done to date of trying to get through all the ponderous material, this is what it all comes down to, guys, right, Justin? It's not that bad. Any questions on this? But are we done? We're not done. Why are we not done? Because we now, once we do this, we have to figure out what is the character of the income to the beneficiaries, right? Well, there's a K1 which is issued, right? There's a K1 which is issued. If you turn a few pages, you'll see the K1. Remember, it's comprised of interest, tax exempt, dividend, rental, and we have 15,000. We have 10,000, 25,000, and 55,000, right? And that total equals 105,000. Already know that. Now, what is the tax exempt income expenses? Well, that's based on the disallowance, right? Right? We already figured out the amount disallowed, right? That's on the front page of my notes on the face of the 1041. The amount disallowed, tax exempt, was $1,142. So that became $8,852. What about direct expenses? Where do they have to be allocated? Direct expenses. Jen? You're pointing. Where do direct expenses have to be allocated to? We know we have to allocate to tax exempt, right? Which is the 10 over the 105 that we did with respect to professional fees and trustees' commissions. That's the amount disallowed, but that's the expenses eligible to the tax exempt. What do we do about direct expenses? Where must they be allocated? To whatever generated the income. So if we have $20,000 of rental expenses, where do they get allocated? Here's a shocker, rental income. Now, we have, how much of remaining expenses are deductible? We started off with 12,000, right? Everyone agree? Started off, we have $10,000 of trustee commissions and $2,000 of other fees, right? We started off with 12,000. How much was disallowed? 1,142, right? Was allocable to the tax exempt. Agreed? How much is left to allocate? Well, you guys can take $12,000 plus 1,142, and the amount. Right? Everyone see that EK? You see that number? Yes. Just say it loudly.
Can you explain the tax exempt minus 1142? Can you go like the formula? 10
If you look at the front page, I had done the arithmetic for you, but the amount disallowed, right, of the 10,000 was $952. Agreed on the front page? Problem 2. You see that? Disallowed, $952. And you see the second amount disallowed was 190. What's 190 plus 952? You got it? Those are the two disallowed amounts. They have to be allocated to tax exempt income. So this is the amount remaining. Where would you allocate this? Say again, please?
Everything other than tax exempt?
Everything other than tax exempt, but if you had your druthers be, where would you allocate it?
Interest.
You would allocate it probably to either interest or rental, right? Because dividends get a preferential treatment, right? Everyone agree? And you have that liberty. You can do that. You can do that. The computer program, let me just tell you what the computer program does. It will do it and did it pro rata. It took 15,000 over 75,000 times 10,858. It took 25,000 over 75,000 times 10,858. Then it took 35,000 over 75,000 times 10,888. And it came up with 2,172. Came up with 3619. And came up with three different numbers, which it then deducted, right? And if you ask, where did these numerators, this came from 15,000 plus 25,000 plus 75,000 equals 75,000. And then it just allocated these expenses and if you look at the K1 that the computer produced here, that's how it got the numbers. If you look at the K1 issued to the beneficiaries, the computer defaulted into taking a pro rata amount of expenses based on the type of income generated. That is not necessarily a good answer for your client, so you may, the more sophisticated computer programs will specifically allocate it, not pro rata, but in the most tax efficient way. But I was just letting you know, you gotta check your computer software to see how it's doing it. Any questions on this? I just wanted to let you know how it's doing it.
I missed the part with like 10,858.
That's $12,000 less than disallowed expense. There was $10,000 in trustee commissions, $2,000 in professional fees, right? That's where that number came from. Just say it loudly. The 75 is 15 plus 10 plus 35. I mean, 15 plus 25. 15 plus 25 plus 35.
So prorata is not required.
It's not required.
You can allocate.
Look at the regulations under 651. Let me just point it out. If you look at 651, excuse me, 652C-4, 652C-4 in the regulations, it is the same chart. And it points out your liberty to allocate it, in this case, all the rents. So I have clear authority. I can do it any way I please. Direct expenses, I don't have that liberty. Tax exempt income, don't have that liberty. Indirect expenses, I have that liberty. Simone?
For exam purposes, what would you want us to do?
I'll let you know.
Okay.
Right? My point is, notice that all of Chapter 3 comes down to Schedule B of the tax return, right? Schedule B, which you compute your D&I, and then your modified D&I, and then you have to, given what I just cited to you, that's a big regulation here. You have to go through this allocation exercise to figure out what is the character of the income to the beneficiaries for purposes of the K-1. My point is, you're not done just when you're, right? We have the trust or estate, we got to compute its tax liability, right? And the beneficiary, we have to issue a K-1, right? So the beneficiary, and most beneficiaries are individuals, will reflect that on their 1040, right? Questions? Everyone's good? Go through these numbers. Now again, look at that regulation. And again, for exam purposes, notwithstanding the complexity of the authors, some of the things they mention here, we're going to try to keep it really simple. Right? Because we're going to get into the minutia. All right. So this is an illustration of a simple trust. Let me just pause for a second since we're on a roll with simple trust. If you want, if you look at example 3, problem 3. Problem 3 is a simple trust with capital gains. Okay? Simple trust with capital gains. Everyone have it? Problem 3, simple trust with capital gains. It has tax exempt, it has interest and dividends, it has a capital gain, and we have to figure out what's allowed and disallowed of these fiduciary and professional fees, right? And here, we do have to employ Manufacturers Hanover, right? Notice the numerator is the tax exempt income, right? What is the denominator? It's not 90,000, it's not adding all the income together, right? It excludes the 40,000 in capital gain. Hence, the amount disallowed, right, is 20% of each of those expenses. Everyone see that? Everyone can handle this. Everyone see those numbers? Anyone have a problem with those numbers? Even without flipping the page, anyone want to guess what is the taxable income of this trust? Shang, I see you flipping the page. Couldn't resist. But it's a simple trust and it has capital gains, right? Some people, not you guys, will say, oh, it's a simple trust, it's not going to pay any tax. But that's not true because the capital gain remains embedded, right? So it remains embedded here. So, now you can flip the page. And you'll see the face of a 1041. And it has the interest, it has the dividends, it has the capital gain. Taxable income of 80,000 bucks. Okay, it has the fiduciary fee, right, and professional fee. Notice it's not 10,000 and 5,000. Everyone agree? Only the portion which is allowed shows up on the face. Okay? So that gets us to our adjusted taxable income, line 17, which now we turn to Schedule B. Turn to Schedule B. that starts us off, right? And we then add our tax exempt, our net tax exempt income, but capital gains becomes a negative number. Agreed? Agreed. So that 35 is our D&I. What's our modified D&I? We have to subtract out 7,000. And our then modified D&I ends up on the front page. We get our $300 exemption. We get our deduction, and the taxable income ends up being $39,700. But
when you have a negative taxable income for a trust, is that?
It's not an NOL, you can't carry it, it just dies there. Okay? Only under code section 642H in the year of termination, and it doesn't include personal exemptions. If the trust had a capital loss or a net operating loss, it passes through in the year of termination.
What code section was it?
642H.
Have any idea what the thinking is on why?
I'm sorry?
Do you have any idea on like what the rationale is for why you can't carry said losses? I mean, I thought the whole purpose.
So there's not a real loss here. I mean, that loss is attributable to, where are you talking about a loss?
Well, I thought you were saying like in general that losses can't be carried for trust.
Right.
So
Your question is what?
So like, what's the reasoning for that in general, like in practice? What was like the intent behind that? 'Cause I thought.
Net operating losses can be carried forward.
Oh, okay, no. Okay.
Net operating
No
losses can, capital losses can. I just made it a loss like on the first problem that we did, and there's the $300 loss, because of the exemption. That's not a real loss.
Yeah.
Can I help you?
Is it temp better?
Much better. Thank you. I can breathe. Everyone
Yeah,
else.
there's three
Yes,
AC
thank
units,
you.
all three of them, I only got one of them running, but it dropped the temp like 3 degrees or
Well,
so.
we are your best friend tonight. Thank you, seriously.
I'll put a work order in for the other ones.
See, no one's asleep, right?
Well, that's a good thing.
That's a good thing. Thank you again,
This
seriously.
is not sleepy time. Sleepy time's for home.
I agree.
All right, guys, have a good
Thank you very much again.
No problem.
On the Schedule B, line, the, tax.
Go home, you gotta scream it out.
Oh, sorry. On the Schedule B, line 2, for the, tax exempt interest, why we are using 7 I thought the, allowable is this one?
The tax exempt,
Schedule B.
yeah, the tax exempt is 10,000, right?
Yes.
But we had to allocate 2,000 and 1,000, right? Of disallowed expenses to it, right? 2 plus 1 equals 3. And 10 minus 3 is 7. Young Hung, do you have the front page of the problem 3?
Yeah.
You see my chicken scratch? Do you see how, with respect to the $10,000 fiduciary fee, 2,000 of that is disallowed?
Okay.
Do you see that, or are you just saying yes?
Oh, yeah, I see. So the disallowed portion is 2,000, then the professional fee or the allocation is 2,000, disallowed 2,000.
Well, the fiduciary fee of 2,000 is disallowed, the professional fee of 1,000 is disallowed. 2 plus 1 equals 3,
Same question.
okay? Okay, you got that? Again, my point is obtuse. I can't say it any other way. Many of what's written, the authors take the most complicated and try to call that to your attention. My job, I consider it my job, is to take these very simple fact patterns, which are very common, okay? This is what you're gonna see. And it's not that hard to take these and show you on a Form 1041 what happens. And distill it down to its basics. That's what's going to happen. So that's much easier. And then, once again, guys, we have to get to a K1. Okay? If you keep turning pages, there's the K1. And we have interest, we have dividends, and we have tax exempt interest, and we have 15, 25, and 10. Okay, let's prove your stuff. How much of the deduction shall I allocate to tax exempt?
3,000.
Thank you. That's what 2, 1, 7. Everyone agree? How much remains, which is deductible? EK, what remains deductible? How much remains deductible, guys? Not a trick question. 12. EK, we had 15,000, right? Of deductions, 3,000 disallowed, 12,000 is allowed. Everyone agree? Okay? We up for this task? How are we going to allocate that $12,000 of deductions? Justin, Simone, Dane, how are you going to allocate the $12,000? What would you do, Justin?
I would put it all into interest.
So you would put it all into interest, okay? I like when Justin's minimizing the tax burden to a client. He could. Everyone agree? You could take that $12,000 and shift it all to interest. Justin, let's suppose your computer program does it pro rata. What would it do?
It would do 15 over 40 times 12,000, and then 25 over 40.
And if you look at the K1, if you say, where did they get the numbers? That's where they got the numbers. Right, EK? Okay? All they did, again, was take a pro rata amount of the expenses. Go ahead.
The K1 is only for one person, so if let's say there were multiple people.
There are multiple people, you would divide it up based on the size of the distributions. Karen, you're going to say?
I know, I wish because I never used the software. How easy is it for you to override the software? Just curious.
I don't do 1041s, truth be told, but my understanding is it's not hard to do. Anyone do 1041s?
I do sometimes, but I never override it.
You never override it? But you could get sued. I mean, think about that.
Yeah.
I mean, I don't mean it badly, but if you don't override something like this, and someone's paying a lot more, I think you've got some issues, malpractice issues.
Maybe the software does that on.
Just check your software if it's doing it automatically. Because I don't think you could just tell, you know, your client, oh, my software did it, lump it. So just be careful if your software just does it, make sure it's doing it the right way. All right? My point again about, I want people to get, again, you're not, for exam purposes, no one's going to fill out a 1041, you're not going to have to compute the tax liability, but by going through this exercise, it vividly illustrates how these things come alive and get reported, okay? So there's reason to my madness, and hopefully it's also to let you sleep at night, that for exam purposes, we're going to keep it really simple, okay? So bearing that in mind, some of the material dealing with complex trust is too complex for the class itself. I do have, I put down in the regulations, we're still on page 178, but that's okay. Make sure when you can, the regulation 662A-3D.
Which page was it?
660, I'm sorry, 662 A dash 3D.
You like raw?
This is the regulation, 662 A dash 3D. There's a nice little illustration. When you get a chance, make sure you go through that yourself, just calling it to your attention. It's easy to follow.
It's 662.
Yeah. Let's just talk about some of the material that I want to call that is important here for our purposes. If you guys have the basics of Tier 1 and Tier 2, I'm really not that concerned about the revenue ruling 67-117. So you really don't have to worry about the application of that revenue ruling. The material that follows, the illustrated material, there's nothing that I'm going to hold you accountable for in that material. If you look on page 182, there's something called the separate share rule. And the separate share rule is designed to bring equity into the picture, to make sure that someone who has limited rights is not overly taxed. I'll repeat that the purpose of the separate share rule is to ensure, or try to ensure, that the right person bears the right amount of tax. And it used to only apply to trust. After 1997, it not only applies to trust, it applies to estates as well. So it applies both to trusts and estates. Also bear in mind, its application is not elective. Let me repeat that. It is not elective. In other words, if it applies, you don't have a choice whether or not it applies. Now, if you could, or when you can, in terms of the application of this, and I'm going to see during the break if I can bring just a quick example from the nutshell down, but if you open to regulation 663C-5, 663C-5, yep, regulation 663C-5, entitled Examples.
C-5.
It's on page 1294. Everyone have it? talks about a single trust was created in 1940 for the benefit of A, B, and C for ages 6, 4, and 2. Under the terms of the instrument, the trust instrument is required to be divided in 3 equal shares. In other words, if you set up this trust, your intentions were that the 3 children were to be treated identically. Each beneficiary's share of the income is to be accumulated until he becomes 21. When he reaches 21, his share of the income may thereafter be accumulated, distributed to him in the discretion of the trustee. The trustee also has the discretion to invade principal for the benefit of any beneficiary to the extent of his share of the trust estate. So you're limited. In other words, it's treated as separate share. Picture, if you will, I set up a trust for Ping, Ming, and Jen, okay? 3 trusts. I set up one trust for the benefit of the 3 of them, put in $3 million. And I'm going to name Alicia as the trustee. But essentially, I say that whatever money is distributed essentially to Jen, suppose Jen needs money and Alicia makes a distribution to her of $100,000. Even though it's one trust and it's going to file one tax return, if Jen gets $100,000, Alicia is not going to take the remaining $2.9 million and at the end distribute it in 3 equal shares. At the end, whenever the trust terminates, Jen is going to bear the onus of that earlier $100,000 distribution. It's as if there's 3 separate shares. Everybody agree? Have the visual of that? In other words, notice what it says here. When a beneficiary reaches the age of his share of the trust may thereafter be either accumulated or distributed to him, the trustee has the right to invade corpus for the benefit of any beneficiary to the extent of his share of the trust estate. And it says that, and the trust instrument requires that the beneficiary's right to future income in corpus will be proportionally reduced. And the point is, normally, that $3 million trust, if it has, just make it up, $300,000, let me use a different number. It has 30,000 of D&I. It has 30,000 of D&I. And Jen gets $100,000 in distribution. In the absence of the separate share rule, Jen would be taxed on 30,000 of the 100,000. Everyone agree? Because if that was the only distribution, right, the distribution that comes out exceeds D&I, it would pull out all the D&I. But under the separate share rule, Jen is deemed to have only a 1/3 interest in that trust. She would have a 1/3 interest in that D&I, right? 1/3 of 30,000 is 10,000, right? So she should be taxed on only $10,000. The remaining 20,000 would be taxable to the trust, and the tax burden, let's just make up the tax burden on 20,000. Let's just say the tax burden on 20,000 happened to be $3,000. What would happen is that tax burden, if I'm the trustee, the trust actually writes the check. The trust writes the check, but I'm doing separate bookkeeping. I would have Ming and Ping bear the burden of that tax because that money, which wasn't distributed, is essentially going to inure to their benefit, right? So that's like that tax payment represents almost by proxy a payment made on their behalf.
So that's why people like set up separate trusts for each
I mean,
child.
personally, my modus operandi when I set up trust for children, I never have one pot trust. My preference, it's not because I want to keep the accountants of the world busy. I much prefer just having 3 separate trusts. I think it's a lot easier to manage than to have one trust and try to do this internal bookkeeping. But some people do set up one trust and then have 3 separate chairs. That's not what I prefer, but that's what sometimes happens. All right, look, let me do this, guys. We're sort of at a natural break point here. I'd like to see on page 186 when we get back, if we can handle those questions. So why don't we take our break now, take 8 or 9 minutes, and I'll see you everyone back here, and we'll persevere, all right?